RESPA is the R, integrated disclosures, PRID. We also hear IMD, integrated mortgage disclosure. That's another word, it means the same thing. And then we're hearing that TILA RESPA forms. All the terms kind of get thrown around a little bit. If I can, let me talk about this. If you will, whoops, let me go back here. Here's my agenda. Won't get there today, okay? So I want to concentrate on the last two items on that agenda with 2 pages in between. July 2010, Dodd-Frank Wall Street Reform and Consumer Protection Act. That was the federal law that was passed that created a lot of the compliance requirements that we have right now, and it was the formation of the Consumer Financial Protection Bureau, CFPB. So we go back approaching now 5 years since that was passed, 4.5 years, heading for 5. It then regulates the oversight of all of those types of credit markets, student loans. Notice in the middle of that litany, that paragraph there, is it talks about mortgage markets. Mortgage markets towards the right-hand side, middle row. That's everything that we do with our lenders, with our mortgage lenders. But look at the other things that it supervises. Everything dealing with credit reports, student loans, older American service members, and so forth. Again, a topic for another day. But it oversees a number of institutions beyond just national and local lenders and credit unions. Supervisory authority, large and small banks, credit unions, and thrifts, enough for that. This bulletin then said that lenders can hire third parties such as title and settlement agents to close their transactions, provided they perform due diligence and make sure that those settlement providers are qualified to do that. I spend about half or more of my time making sure that we as a company are competent, qualified, and approved by lenders. Big deal, I mean, big job. Okay, let's get to the heart of this right now. Starting August 1, if you're making notes and haven't heard anything about this, loans originated from August 1, 2015 and forward are subject to those new disclosure documents that I just mentioned. Not for loans in process, not for transactions that were originated prior to August 1st, but loans that are originated August 1st and forward. Why is that, or how does that all come about? CFPB wrote these 8 rules. Again, topic a lot longer than I'm going to have time to talk about today. But on the upper one, the upper band, light blue there on the top, talks about integrated mortgage disclosures. It simplifies, wishful thinking, it simplifies RESPA and TILA disclosures by putting them into now a 3-page loan disclosure and a 5-page closing disclosure. So what we've been seeing, for those of you that sit through your closings or look at those Type 1 settlement statements, historically, I'm looking around the room, there may be some people who are practicing or selling real estate in 1974. I won't ask for a showing of hands, that was 40 years ago. It was a change, what's sometimes referred to as a sea change on forms, and that's what was created in the RESPA Settlement Act of 1974, was that 2-page HUD-1 settlement statement that you're now using on every residential real estate transaction, okay? Became very common, page 1, obviously the totals were on the page 1, buyer and seller on separate halves of that document. Page 2 was a breakdown of the itemized fees and cost of closing. It drifted into a 3rd and a 4th page with payoff information and other disclosures, but it started off as a 2-page document. That form will be replaced effective August 1st of this year, so 40 years of practice, 40 years of familiarity will disappear, and it's all because the CFPB wrote these 8 rules. The first one on that list deals with the integrated mortgage disclosures. It was then issued, the rule was issued in November of 2013. I think this is important to know too. It gave the industry, what is that, about a year and a half plus to get ready. So we're still in a preparation stage, and those of us that have now been connected to our computers and do all of our closing work on computers, it's now, the race is for the software companies to make sure that the systems will now adapt to those modified forms. Basic overview. Integrated the 4 TILA, Truth in Lending Act forms and the RESPA disclosure into, again, a 3-page loan disclosure and a 5-page closing disclosure. There's new timing. You have to make those disclosures 3 days before, here's a new word for your vocabulary, consummation. The Act talks about consummation. It doesn't talk about closing, settlement, signing, data prorate. It talks about the word consummation. The consumer, the borrower, is entitled to get their closing documents 3 days before consummation. I think that term will continue to use the word closing and settlement because that's what we're comfortable with, but the Act talks about consummation. The other thing talks about that 3-day rule. If there's changes on that settlement statement that affect the APR, the annual percentage rate calculation, lenders will have to redisclose and extend closing in another 3 days. We're in for some challenges in looking at people that have set their closing date based on their move-out date, based on termination of rental property or selling a prior home, and then all of a sudden, because there's changes, last-minute changes, there has to be a redisclosure and another 3-day waiting period. I think we're going to be in for some challenges in that. So we don't know what that means right now, but the law is very clear. If there's more than $100 difference that affects the APR, you have to redisclose, let that 3 days start to run again. Okay? Note up here, and I don't have a laser pointer, but scope of the rule does not apply to. For those of you that work in the reverse mortgage area, does not apply. These forms are not applicable to reverse mortgages. They don't apply to home equity lines of credit. I love chattel dwelling loans. What's that? Mobile homes. Okay? Doesn't apply to mobile homes and transactions involving mobile homes. Loans made by, again, five transactions or less, and then certain, no interest rate loans. So if you're in the mainstream of handling buy-sell transactions of residential property, you're going to be affected by the new forms. Here they are. You can't read it. And again, one thing I will do, if you give me a business card, I will send this deck to you. So if you want to see these forms, become more familiar with them. Highlighting this 3-page, replaces the good faith estimate, the GFE, and the preliminary Truth in Lending Act. Needs to be delivered by the credit or the mortgage company. This is something as an industry we're still trying to sort out. Who's going to send that out, the disclosure? Title companies historically have been responsible for the HUD-1 prep and sending that out to the consumers. We're going to have much more activity by lenders. The lenders are going to send out those disclosures because they have the liability for making it correct and accurate and timely. And then the settlement agent or the title company, escrow company, will be responsible for filling out parts of it. So that current, sometimes I call it a choreography or a dance or a ping pong match back and forth on documents. We're going to see that continue between the lender and the title company as we go into closing. 5-page disclosure, about all I'm going to say on this. It's longer. And those of us that have gotten very familiar with line item references, 1106 and 1202 and those line items, has no numbers on it. The numbers are gone. So even the familiarity of being able to then talk to someone on the phone and reference a line number so you make sure you're talking on the same subject, I'm not convinced that that's going to be easier than what we've seen in the past. But again, be aware, no line items as we go forward. And then the last bullet dot on here, the delivery requirement, again, customer must receive it no later than 3 business days prior to consummation is the term we continue to use on that. All right, I'm going to skip that, and we're going to talk about some of the challenges briefly. The integration of those, obviously we've got lots of information that has to then come onto a common document. Lenders are responsible for the borrower side. We're going to see much more responsibility or heightened responsibility on the part of the settlement agent for the seller side of the document. That information is going to have to come and be married onto a common document, obviously being one that's signed by all the parties. New timing, we talked about it. Tolerances, we talked a little bit about that. The pre-disclosure requirements, who will prepare and deliver, that seems to be the question. The one thing I'd leave you with this morning, as you're talking to lenders that you work with frequently, you're part of your team, those lenders. The title agent, the title or settlement escrow companies that you work with that are part of your team that you work with all the time, you should be asking them questions about how are they prepared, what are they doing to be prepared for these integrated mortgage disclosures, because it will impact your business. Final topic, final subject, skip off that. Final subject, I always take an opportunity, why is this important to you? Okay, just give me about 2 minutes. I think by being prepared for the changes in the law and being familiar with the forms that now your consumer and your customers, your clients will be interacting with going forward from August 1st, being familiar with those, being able to be prepared to explain those, I think it raises your ability to then differentiate yourself in the marketplace. That's one thing. You have a few months to get prepared for it. You have a few months to then prepare your team for that so that they're prepared, so again, you don't lose any type of momentum in the marketplace. Number two, when we start talking about other things, and Scott touched on this, we start talking about protecting NPI, there's another acronym to add to your vocabulary, non-public private information. Work with title companies, work with lenders that have high standards on the protecting of consumer data, because the last thing you want to do is be associated with a referral, and all of a sudden their information gets hacked, their information gets taken, you don't know where it is, you don't want to be involved in that. You will differentiate yourself by, in your listing presentations or in any of your presentations with your client, talking about how you, your office, and the team that you assemble have the highest standards on the protecting of non-public private information. It can't be just words, you have to back that up. But this is a differentiator, a lot like these other materials that I presented to you. I think you get a working vocabulary and compliance, you implement some of these changes in your office, you will differentiate yourself in the marketplace, you will win more listing appointments, more listing presentations by not having that and being a little further along with the market. So, thank you.
Thank you. So Hovik and I had breakfast. Hovik is our next speaker from New American Funding, and we had breakfast last year at the end of the year. We were talking about all the things that we were doing to prepare for this, and Hovik started to talk about all the things that they've been doing over the past couple of years to get ready as well. I talked to a bank the other day who said their compliance department was 14% of their budget. Today it's 44% of their budget, trying to prepare for all these things. So Hovik is a top loan officer and branch manager at every place he's ever been, works with over 100 listing agents, and he's going to update you a little bit on what lenders are going through with this process.
Good. Thank you. I'm going to talk to you from just the perspective of loan officers or loan originators and real estate agents today, because I think that's very appropriate for what we're doing. I'm, like Scott said, I'm with the New American Funding. The CFPB I'm very familiar with, and even its predecessor. When I was at IndyMac and the FDIC took over our bank, I was basically on the front line. So I have a particular distaste for government entities and what it is that they do when they come in and take over. And just to give you a little background, when the FDIC took over IndyMac Bank, they sent one person into the office, they shut down the doors, and they said, okay, Monday we'll open up as IndyMac Federal Bank. And on Monday it was the same staff, same number of people, and about 500 elderly people standing outside the door trying to get their money out. So what I will tell you is that they're very aggressively chasing down violations. And when I say they're very aggressively chasing down violations, these are just a couple of examples. Capital One being fined $210 million for deceptive marketing. Flagstar Bank paying a boatload of money for violating the new mortgage servicing rules. Lighthouse Title getting fined for, outside of banks, now Lighthouse Title getting fined for kickbacks. There's a case in point, I don't have it in front of me, but a real estate group that hired a title rep. Group's wife happened to be the title rep, and they basically put him out of business because she had only one customer. There's a builder in Texas that got over $100,000 fine for presumably getting kickbacks from their mortgage lender, their preferred lender. And what I wanted to touch on today in just the few minutes that we have is why it's important to stay compliant. Because essentially, and I've got a slide that's coming up that's going to point this out very clearly, but essentially they can go after more or less anyone that they deem to be a violator. And what I'll tell you about being a violator is very, very simple. For any of you that deal with listings, have you ever received a client's bank statements that show that you have a deposit or enough money for the deposit? Okay, so if you were to come under the scrutiny that we come under, what are you doing to protect those documents at this point? Does it go on your desk and just sit there for a few days maybe? Or does it go into your transaction and go out there? And if that person's information gets out, what is your written policy as to what you're going to do to protect that person's credit over the next 3 years? And if you don't have one, you should, I would strongly consider not collecting clients' non-public personal information. It doesn't matter if it's New American or Skyline or Prospect or Bank of America or Chase. You want to deal with a direct lender that's already got safeguards built into place where they'll protect this information. You don't want to deal with a loan officer or a loan originator that you know if they issue a pre-approval letter that doesn't have that client's social security number on it, doesn't have any of their private information on it, doesn't have anything other than their name and where they're buying, that you can trust that transaction is going to go through. And the other part of the problem is, even if you are the one protecting it, how do we as an industry start getting everyone on the same page? Because you may be on the other side where you're submitting an offer and the listing agent says, no, I want to see their bank statements. So now the onus is on you to protect that person's bank statements, and how do you protect them? I will tell you that most large mortgage lenders, and I don't know if you could tell from my name, but I have an Armenian background. I've been in the mortgage business for 25 years. I have a lot of people asking me, you've been in the business for 25 years, why don't you open your own mortgage company? And I'll tell you right now, it's impossible to do that. You can't just go out there and open a mortgage company, because essentially, I know our company spent several $1 million ensuring compliance. We have 3 attorneys on staff full-time, and we use outside counsel to make sure that we're protected. Our chief compliance officer, the chief legal counsel of the company, the COO, the ownership, every employee goes through training numerous times a year, and we have certifications that basically say that we know how to protect our clients' non-public private information. You touched on vendor management. There's a whole mess right now, and I'll tell you, like in the last 25 years, this is the most, even though we're all paperless, it's the most paperwork intensive industry I've ever been in, because if you are an escrow company that I have to deal with and you're not on an approved vendor management site with New American, I now have to either go through the process of getting you approved or finding out why you're not approved, or trying to convince the agent that, hey, this is not a vendor partner that we want to work with. I mean, Scott and I had a conversation a couple months ago about a very prominent escrow company in Ventura County that is part of a real estate group. And I said, hey, Scott, is there anything wrong with these people? And he talked to all these people, no, they seem to be okay. Well, they're not on our approved list, so what do we do now? And it was just it was a pain in the neck trying to get either the listing agent to change escrow companies or to get that person approved on the vendor management list. But it is important, because it could literally put us out of business. The CFPB's attitude is that even though they don't regulate escrow and title, they understand that we'll have to work with escrow and title, and since we'll have to work with escrow and title, they're going to regulate us to make sure that we do the right thing and keep them intact. Oops. There's their attitude. We recognize that you have to work with service providers. Since we don't directly regulate them, we'll leave it up to you to do so. So the way we do it is we have a approved vendor management list that comes out bi-monthly. If you're on that vendor management list, that's wonderful. If you're not, then we jump through hoops to get you on there, or find another escrow company or title company to work with. I want to touch on MSAs, ASAs, and JVs, because a lot of real estate companies have them. The traditional JV model, joint venture model, where you went into partnership with a mortgage company, I would say at this point is non-existent. It's no longer a matter of, hey, come up with $35,000 and we'll come up with $35,000 and we'll create a new company and we'll split the profits and do everything else. If you are in the mortgage business, then you're basically being held to all the standards that a New American or a Skyline or a Prospect or a Bank of America would be held to. So it becomes prohibitively expensive to be able to do that. However, MSAs, marketing service agreements, ASAs, advertiser service agreements, and desk rentals still do exist. But I'll tell you the biggest difference now is 5 years ago, I could go to my company and say, hey, I have an opportunity to rent some office space from Remax Elite, for example. And I'm going to pay Silva $5,000 a month for that opportunity. And they wouldn't even question it. They would say, okay, no problem. We don't have a location in Glendale. You're going to have an office there. We're going to pay her $5,000 a month for you to be able to sit in their office. First of all, that doesn't work anymore. So, today, I have to show that in that market, that is a fair market rent. So The steps I have to go through as a lender are, I'll have to contact the nearest Regis location. So there's one on Central and there's one on Brand, and I'll have to tour their offices. I'll have to get an actual bid from them. And that day, at that time, this is what it would cost to rent that office. So if she's making available a 15 by 15 office, secretarial service, answering phones, internet, and phone, what would that cost at Regis? Is it $1,200 a month? Then I should be paying her $1,200 or less, basically. With the advertising services agreement or the MSAs, I will tell you, in the past, again, we would go in there and say, hey, here's a list of things that you can do for us and to advertise our services, and for that we'll pay you a fee. And we just sort of would pull the fee out of the air. It didn't really matter what that fee was. Today, all of that is validated by a third party. So essentially, we'll still sit down and we'll give you a list of things that you can do to advertise our services that would help facilitate business for New American Funding. You'll agree to, let's say, 10 things to do on a regular monthly basis. And then we have a third-party vendor that will actually go through and say, okay, for that size an office, with that many buy-sides, with that many listings, the fact that you're on their website, on their banner, is worth $35 a month. And they'll actually break it down item by item. So you can do MSAs, ASAs, and so forth, but just be prepared to own up to your end of the bargain. When I say your end of the bargain, real estate company, if you agree to send out 15 emails a month to your entire database, know that at the end of the month, someone's going to want to see those 15 emails. What was the content? What is it that you promoted? How many people did it actually go out to? And if you didn't do it, you know, what's your policy in refunding that money? I mean, that's unheard of in the past. Is that, hey, we understand that you can't do this every month. Things happen, but if you don't do it, are you returning the money that didn't go towards advertising? It would be similar to buying airtime on the radio, and the radio station just didn't put us out there, so there would be some sort of credit back. The only other thing I'll tell you on MSAs, ASAs, and JVs is just be aware that it's certainly out there. It's a way to facilitate additional revenues, help your agents out, help in marketing, and so on and so forth. But you will all be held to a lot more scrutiny as far as, are you actually doing the activities? What do those activities look like, and so forth. This is the newest and greatest from the CFPB, and I'm telling you right now, I mean, we really need every individual's help to reach out to your respective, elected officials and tell them that this is absolutely ridiculous. As of today, you can go on the CFPB website and check interest rates for your situation as a consumer, which in and of itself is not a bad thing, but I went in yesterday and I put in for a typical Glendale transaction, I would imagine. It's in the $800,000 range with 20% down, and it told me that the interest rate that I should be paying is about 3 7/8. Any lenders in the room? Okay. I don't know if 3 7/8 is typical for your market, but the same guidelines that they're holding all lenders up to, the CFPB doesn't hold themselves up to, because essentially it doesn't tell you how many points they're charging, it doesn't tell you what the closing costs are going to look like, it doesn't tell you what the APR is. It's just saying most lenders in your area are going to be at 3 7/8. And when you look into that further, you don't even know who the lenders are that they're serving. They say they've got a private company that's giving them this information. They're surveying lenders. I have no idea who those lenders are. I don't know if they're regional or if they're national. If it's for their private banking clients. If it's for your typical consumer. It doesn't. I put in a FICO bandwidth, but FICO's within 50 points could make a world of difference between what you can get and what you can't get. There's actually talk about them doing this with other types of consumer services. What should you be paying for your student loans? In your market, what should the average commission be that you pay your real estate agents? I mean, that's believe me, at some point, the guy that runs the CFPB is a 5-time Jeopardy winner. He's going to find different ways to skedoodle all of us. In summary, it's no longer too big to fail, it's too small to comply. If you're not dealing with a national lender, or not necessarily a national lender, but someone that's got the wherewithal to be able to protect your client's non-public private information, for having policies on service providers, for having policies on whether or not you're actually benefiting from their services and how they disclose that to your clients and how much those fees are. I would strongly encourage all of you to interview several and get into business with someone that will make sure that you don't get in trouble. That's me. Thank you.
Thanks, Owen. So for us, the Panga Group, Millie Miller is going to talk next. Our kind of theme this year is the year of forward thinking. And for those of you who don't know, escrow officers don't like change. And it's not so much that we don't like change as much as the fact that we might change a system or a procedure. We're kind of a volume business. Might affect how something might get missed or might be an issue, and the last thing we ever want to do is let a realtor or a lender down. And so for us, we're having the conversation about how does this going to affect our industry today, but in 2016 or 17 as well, so we can have those discussions and try to get everybody on the same page, like COVID said, now and within our own companies, but also as an industry, and that's part of the reason kind of why we're doing this today. And so Millie oversees escrow operations for the Pango Group. And I'll let her talk a little bit now.
Hi everybody, I'm Millie Miller, and I am Escrow Operations Manager for the Pango Group, which is Glen Oaks Escrow, CV and ATE. We've been working on this for a few years as well, and part of what came down the line is basically the things about where did it come from, who's Dodd-Frank, why did this even happen, and today, what have we learned in working on this for 2 years? And what can we do as a team working all together to make sure that we're ready at the highest level so that your deals go through. So that's basically what we've been working on our end. So a lot of the things that basically the law is for the lender. The lender is responsible for anything that we do as their vendor. So the things that they've put in place is detailed operations. So what does that mean to us? Well, for what they're going to ask of us is policies and procedures. Do we have them written down? I mean, we all know what we do on a daily basis, but do we write them down? That's what they're going to want to see. We have to have a complaint tracking system in place and available. So if a lender asks us for it, we have to provide it to them. We need to do security checks. So we've gone through and we've had every stage of all of our systems checked. We've even had a penetration test done. We actually said to an outside company, come and see if you can hack our systems. So we've done that. We have to have yearly testing of that. We have to have yearly training. We have to have our due diligence as far as what we expect of our vendors. So we have, I think Scott knows the number, I don't know if it's like 64 or 84 vendors that 87 vendors that we've actually gone out and had to get confidentiality agreements and ask them for their financials and make sure that they're at the place where they need to be so that we're saying the truth when we talk to the lenders and saying this is what we've checked and they're up, above board. We have HR. HR is put things into place where when we hire a temp, even if it's for a day, we have to have a background check done on them. And so these are things that we have to continue. We have to have onboarding and offboarding policies. So if we, get a new employee, what accesses are we giving them to the systems? And when they leave or they quit or they resign or whatever, what do we do to make sure that those systems are protected? Mobile devices. We have, as in the new world, right? We all have mobile devices. We carry around our phones. We carry around, laptops and iPads. Well, how are those protected if they're lost, if they're stolen? So as a company, we've actually invested in a program that actually protects not only the private personal information that we might have on the systems, but it also protects our employees. So if their phones or if their iPads are lost, we can wipe out all personal information that's company related, and still their phone, their pictures, their personal things won't be gone for them. So we've done those kinds of things. Facilities. I mean, we've had to worry about, how many access stores do we have? Can people get in and out and access behind the scenes? Clean desk. I mean, that's a big deal for escrow. We like to deal in paper, which is something that we're working on this year. A forward-thinking logo up there. We're moving towards a digital world. We're moving towards getting rid of files. In the meantime, we've had to invest in locks and cabinets and keys and swipey keys to get in and out of the building and all kinds of wonderful things that we've had to do to make sure that we're compliant. So that's a lot of what we've had to do on our end, and we're able to say to the lenders we're ready. So that's basically the thing there. So confirming, so these are things that we've also done to protect, in addition to even the things that some of the lenders are asking for, because of the things that have happened in the industry, the hacking of the funds and the escrow companies being shut down. We've actually centralized our wiring system, so it's completely off of the servers. It's a completely separate server. We always have done reconciliations. We're doing them daily. Most companies don't do them, only monthly, but if you do get hacked and there's a wire taken and you notice it right away, the banks are able to help you out. If you wait for 30 to 45 days, it's gone. And once it's out of the country, it's gone. There's no way to go around that. Positive pay is something that comes up into our computer in our banking department and says, hey, there's a check that wasn't notified to the bank that was issued, so we're able to stop that before it even happens. Again, our paperless systems that we're trying to work on, the cell phones that we've established the software in, hard drives. We realized that scanners and even the equipment that we get rid of, it has hard drives, so things are saved in there. There's private personal information. You sell that equipment, you give it back to a company, it's got all that personal information. So we've learned that we actually have a company that cleans that all out before it actually goes back to either back to a leaseholder or the being sold or however it's being discarded. Vendor and temp management, which is what I discussed before, and we've actually put very strict rules on that in place. And our business continuity, which is making sure that our systems will continue to service the clients even when something goes down. So we've had incidences in other offices where there was floods and you can't get into the building, and so we've put things in place where we can switch that over to another office and get those files done, get business done, right? So that's kind of the stuff that we've done. This is this is one of our this is one of our employees at one of our offices, and basically the NPI and the NPPI is basically the non-public private information, and it's identity protection for your customers is basically what it's about. And we've kind of made it fun, and the offices have kind of jumped in, and some of the employees will go around and go, oh, you got a nice extra file on your desk, and you get a little ticket for that. You got to buy everybody ice cream, and so we've done it's made it fun, but at the same time we're making sure that we're following up on making sure that everything is protected. So we no longer have trash cans, we have shredders. So things cannot be tossed in a trash can and sit out there. We actually get them in a shredder box, and they get shredded, and the shredding company comes and takes it away, it's all locked up. And so it's kind of, we've made it fun, but it's a lot of work. It's a lot of effort on everyone's part, and it's a big deal. It's a big deal. I mean, we see the hackings and the information and the identity theft going on, all over the industry. Encrypted email, I know that's a sore spot for a lot of you. I know everybody hates that, right? It's like, what is this? Why am I getting this? And I don't know how to get into it. It's a big deal, and through it, we've seen what actually happens. I mean, we have thousands. This is on a monthly basis. 220,000 emails that are blocked because they have something. There's 21,000 viruses that get blocked because of the systems we have in place. We've seen the email, what they call email spoofing. You send out a wire instruction to a client, their email gets hacked, and they change that information. The client's going to go to the bank and wire $300,000 into someone else's account. If that happens, it's gone. So these are why we say encryption. So it's personal information. It's any banking information, any socials, any driver's license, anything that can affect someone's identity. They say even a name and address connection can be stolen and can take someone's identity. So it's a big deal. I know it's a hassle. I know that everyone hates it. And just know that when it's coming to you, it's because we want to protect you and your clients. It's not because we want to make everybody's life harder. So just kind of be on the lookout for that. I know everyone's, and we've actually put a lot of work into it to figure out what kind of systems we can use that can be the easiest thing. This is what we've recently done, which is the SSA 16, SOC 1 and SOC 2 Type 1. It's actually very known in the industry in the mortgage world. They understand it, they get it. A lot of the lenders that are actually asking for approvals out there are asking for all of this stuff, policies and these kinds of insurances and those kinds of insurances, or the SSA 16 certification. So it's a huge, long, drawn-out process. It was months and months of internal work as far as external work from an independent third-party CPA firm. Very expensive as well. And it just takes a lot of effort, but it has proven for us to be very valuable. We see a lot of the vendor management coming to our way and asking us for a lot of documentation. It has saved us tons of time by being able to say we have our SSA 16 and moving forward. There are some companies out there that will still not accept that, and they're actually pushing to have our personal employees put personal information in their systems as well. And we're kind of right in the process right now of fighting that a little bit within the industry, across the board with Escrow Association and DBO and Escrow Institute. So those are things that we're still battling because of all of this, but know that the industry is definitely up taking the lead in that and making sure that your clients and your deals get done and don't get stalled at the funding table and don't get stopped. And there's just a lot of that happening, unfortunately, right now. We've actually been requested, it's probably about over 40 lenders at this point, but we've sent out policies and procedures, best practices, what we've done, and been approved. One of the companies we're approved with is New America, and it's a multi-page questionnaire along with requests for lots and lots of things. I mean, E&O insurance and cyber insurance and all kinds of other things. And just, even some companies out there don't even have E&O, so we just always wonder how is that even getting approved. But the lenders are asking for a lot more nowadays. And so as the servicers, like Jose said, the teams that you work with, be careful, ask the questions. Just ask them, what are they doing? What do they have in place? What are they seeing? So that you can kind of be prepared before it gets to a funding table, before it gets to a document time. So these are things that are highly on our list of things that we are concerned with on a daily basis. The closing disclosure, like they said, that's coming out August 1st. It's for deals that start as of August 1st. Our biggest concern for all of you in this is to discuss things that can create delays later on. If you're listing, talk to your sellers. Let them know that a 30-day closing is probably out of the picture. Actually, most lenders have told us 30-day closing is just not going to happen after August 1st. There's multiple days for them to disclose on the loan estimate. There's multiple, if there's a change in an appraisal, if there's a request for a change in a credit, if there's termite issues, repairs, any change of a loan. Sometimes the buyer says, oh, I want to do a different loan type, and they're towards the end. It's a whole redisclosure process. So on top of having to maybe go back to underwriting and create all that time, now they have to create additional time frames for disclosure. So just be aware of those, have those conversations with your clients up front. I think it'll set you all apart to know that you can have those conversations, prepare them. Don't let a seller believe that they're really going to close in 15 days if the buyer's getting a loan. It's just not going to happen. And it's going to set you guys all apart by knowing that up front. So we're just hoping that all helps all of you to be able to have a little bit of information, know that we're all available, all of us. We've been working on this for a long, long time. So if you have questions, if you have concerns, if you have clients asking you things, by all means, reach out to us. We would love to help. Basically, this is about getting the industry together and all of us knowing what's really happening so that we can all work together. Thank you so much.
So I know that was a ton of information that we've been working on for 2 years, and we just gave you in about 45 minutes. I think Silva and Dan and Greg really wanted this information out there. Some of you are attending CER, so you can start to ask the questions and be prepared as we move into and kind of get us all on the same page as an industry. And so again, we're all here for you and as a resource to have these discussions, and I think we'll be having more of these as August 1st approaches. So thank you very much, and I don't know if we have time for questions or...
First, thank you. It was very informative for me and for the group. I want to thank you all. Dan Lanning, our CEO, has something to say.
I promise to be real quick, but some of this stuff that's happening with identity theft and making sure that we protect your identity has already started to happen at the association level. And many of you kind of get a little bit perturbed with the staff because you say, well, you have my credit card on file. No, we don't, not anymore. We don't have your credit card information. We don't have your social security number. We don't have your driver's license number. We don't have any of that stuff. It's all been totally erased from our database. And what I want to encourage you to do is, when you have a bill to pay, please do it online. Because what happens is, it's processed through e-commerce in Chicago, and the minute it is approved, your credit card is wiped out. We can't go back and pull up your credit card and look for it or anything, because it's all done for your security and your identity protection. So we've done a lot of this, and we're going to go paperless at our office as well. And we're going to put all that stuff, attach it to your membership record, and shred it. So when you send or request a credit card payment, you go online and you fill that out, fax it to us. Don't email it to us. Fax it back. We process it. Once it's processed, it goes into the shred bin. We have a lock, secure shred bin also. So while we're not under the scrutiny that these escrow companies are, you know, everybody wants a piece of the real estate action, so they're looking at everything. So we're doing what we can to protect your identity just as well. So remember, there are safeguards in place. So when we ask you for that credit card again, it's for a reason. We don't have your credit card anymore. Used to we did, but we don't anymore. Okay?
Thank you, Dan. You know, a lot of the content you shared with us prompts us all as brokerages as well to think about what we're doing when we're getting those pre-qualifications, pre-approvals, and clients' financial information. And in fact, this gave me a great idea. How about the next one with a broker panel? Would you like something like that? Broker panel from different organizations where we can have these kind of, you know, more interactive discussion with agents and brokers. Again, thank you so much. We're, because of time, I don't know how much, we have time for question and answer, or how are we doing with that?
Well, if you want to take 10 minutes at max and for questions, otherwise you can, I'm sure they are happy to answer your questions one-on-one if you come up.
Absolutely. Scott? Toby? Oh,
Yeah.
well, how about we take 3 good questions, okay? 3.
Okay.
Ira.
If you're involved with a small escrow company, if that escrow company has not been blessed by the lender, is that deal going to fail?
Is the deal going to fail if you're using a small escrow?
Can that escrow company legitimately handle the deal if they are not qualified with the lender?
Generally speaking, the lender, if they're not on the approved vendor list and they can't get on the approved vendor list because there's been issues or they don't have the proper paperwork, then we as a lender would not work with the escrow company. So we would go back to the agent and say, look, we can't use this escrow company. You need to either select a different lender that's willing to do that, or select a different escrow company so we can work with them.
Yeah, we've had.
I'd add one more piece, excuse me, Scott. What we've seen in this last year or so, because the rules are new, you may get a waiver one time or be okay the first time, but you're not necessarily going to have that a second or a third time. So you may get it passed, but if they don't have policies and procedures in place, prove that they've been doing training, they have a consumer complaint tracking vehicle, and some kind of audit on past files. That's the 4 things, the highlight, the 4 most important things. If they can't prove those to the satisfaction of the lender, they're probably going to be very short-lived as far as their relationship with us.
Second question?
I have a quick question. Thank you so much, first of all. What would happen if you had the buyer on a deal and the agent loved your offer, but they didn't want to take it unless you gave the buyer's personal information, like a bank statement, for example? I mean, how do you protect them? What do you do? That any of you guys who can answer that, because that, when you guys brought that up, that freaked me out.
I've talked to 2 brokers in the past week that they are working on potentially getting the same SSAE 16, the SOX audit, and working on that in 2016. So I think with Silva's idea of a panel and talking about some of those things, you all might have to have or should have a written detail about how you move forward those to each other. So things like that.
Okay. And third and last question.
This question is for John. When you say that if the APR changes just slightly, let's say by $100 difference, if that change is going down in cost, would that be any different?
That's your logic, and you think that would be helpful.
Yeah.
But it does not say that it has to be
Doesn't
to the benefit or the detriment of the borrower. It's a change, upward or downward. You know, that's one of those things. A change is a change, and unfortunately, even if it's beneficial, there's a redisclosure.
And for us, there's 2 things that are coming up right this second, is that traveling notary. Sometimes we don't know when we're doing an estimate if there's going to be a traveling notary. That could affect the APR. Possibly. That's a discussion right this second of will it be included or not. Recording fees is a discussion as well. We don't know how big the deed of trust is or what we're going to record sometimes when we're getting an estimate or an estimate. That could affect the APR. So those are some of the things that they're still in negotiation of how it'll actually be implemented in August. But those are 2 things for us we're really concerned about because we don't have the answer when we're doing those estimates.
And I think it'll change from lender to lender. I mean, just kind of like it did back in 2010 where one lender thought one thing, and it'll change a little bit. Those kinds of discussions, because they're up in the air and it's happening.
having 2015 August, it'll be a little different, even from day to day with each lender, I think could possibly change for us.
Well, thank you there. Our guests, our panelists are willing to stay for you to ask questions afterwards. And thank you again.
Thank
Really
you all.
appreciate it.